Hello friends, I'm back again. Today let us discuss about chapter 4, trends, the basics. Just quickly have a review, pause a moment and review the objectives and the expectation for this video. As I mentioned, today we are going to discuss about chapter 4, trends, the basics. Very important. Observations and rules are not specific for this chapter. The difficulty of profiting from technical analysis is not with the rules themselves, how we apply them. Trends and patterns are not mechanical, that can be easily programmed and tested on computers. This is theoretical. There are some softwares which provide trends and patterns which can be easily identified through computer programs. Theoretically, they are mentioning that trends and patterns are not mechanical. That can be easily programmed and tested on computers. Major criticism, it has yet to be thoroughly computerized and tested. True, there are many opportunities available to computerize the trends and identification of trends. Trends are constant and they are the source of profit when recognized and properly used. Basic. Suggestion for students. Student trade on paper money. And finally, with small amounts of money. Trend, the key to profits. What is the objective of this section? Profit with minimum capital risk. Even if you're not making profit, that's fine, but never lose your capital. Determine. Number one, determine with minimum risk of error when a trend has begun at its earliest time and price. Identify the trend at the earliest. Second, select and enter a position in the trend that is appropriate to the existing trend, regardless of the direction. Either upward or downward, stick to the direction of the trend. Never trade against the trend. Close those positions when trend is ending. Most expensive education. Money lost in incorrect, sloppy, and undisciplined decision. We should have a disciplined approach. That's why we are pursuing CMT. All market participants make mistakes, but the regimented professionals correct theirs. Trend terminology, sideways trend, trading range or neutral area. Trend following techniques work poorly in non trending markets. Sideways trends are a movement of price within a range. That is sideways trend or trading range or neutral area. Trend following techniques never work in this sideways trend. Basis of trend analysis, Dow theory. Trends are fractal, meaning in the higher time span, whatever the pattern or trends we are observing, the we can see the similar patterns built up in the lower time span as well. For example, if we are seeing a trend or movement of price, upward direction, basis of trend analysis, Dow theory. Trends are fractal, meaning if you remember in chapter 1, we discuss about fractal like snowflakes. When we keep snowflakes under a microscope, every tiny particle of the snowflake looks similar. Same with trends. If we see a upward trend in monthly chart, we can see the similar upward pattern in the daily, hourly, minute chart, etc. as well. That's what they mean. And all the concepts covered in the chapter 1 applies this part. Trends are fractal. Any particular trend is influenced by its next larger and next smaller trend. Longer trends will influence the strength of the trend of interest. The shorter trend will often give early signs of turning into longer. Here we have a trend. In this trend, these are smaller trends, and this one is a longer trend. These are longer trends. So, always the longer trend supports the upward trend if it happens to be an upward trend. Otherwise, if it is a downward trend, then it's a vice versa. Smaller trends will give indication for the longer trend. In the small, Dow suggests not to trade during the opposite direction, which is smaller trend. Trade always in the longer trend. How does investor psychology impact trends? Supply and demand establish the price of any goods. The security market is no different. How is the trend determined? A trend is never a straight line. A trend is direction rather than a line. When we are traveling in a car from one destination to another, we won't go in a straight line. We take lefts, rights. Similarly, even in trend is not a straight line. There are ups and downs. That's what they're trying to explain here. Trend is never a straight line. Peaks and troughs. The easiest is to look for peaks and troughs within a series of price oscillations. Upward trend, if the peaks tend to be higher than the earlier peaks and the troughs tend to be higher than the previous troughs. This is upward trend. Peak, trough. The peaks are higher than the previous peak and the troughs are also higher than the previous trough. And similarly here, the peaks are higher than the previous peak, troughs are higher than the previous troughs, which is called upward trend. Downward trend, if peaks and troughs are lower than the previous one, opposite to upward trend. Trading range, if the peaks and troughs occur at the same relative levels. This is a trading range. There are two lines within which when the price movement happens, this is trading range. Undeterminable, if the peaks and troughs are scattered around, then it is mentioned as undeterminable. Determining a trading range. When does the trading range happen? Occurs after a larger trend has come to a temporary halt. When it is an upward trend or downward trend, where does when it halts, there happens a trading range. We can call it as trading range, consolidation, congestion area, angle formation, whatever it is, everything denotes trading range. What is support and resistance? Resistance point. When prices have been raising and then reversed downward, the highest points in the race peak, which is called resistance point. In this picture, which are the resistance point? Highest peak. This is a resistance. And here this is a resistance. And this is a resistance. The highest peaks are called resistance points. A level at which advance has met with selling resistance. There is a advance. Why does the advance happen? Buyers were interested to purchase the stock or whatever it is. When the selling comes in, when the seller stops the buyer to proceed further, there comes the resistance. Sellers are as powerful and aggressive as the buyers and halt advance. Sellers, which is supply, become more powerful and aggressive than the buyers demand. Resistance zone, more than one resistance level occurs at roughly the same price. Here, if you see, this is a resistance zone and this is another resistance zone. Both are almost at the same price. This level is called resistance zone. When we draw two lines, we'll get a resistance zone. Support point, opposite of a resistance point. Support point, buyers become more powerful and aggressive as the sellers and halt price decline. Support and resistance zones will carry through time and become barriers to future price action. Not only the zones carry through, but once they are broken through, they will switch functions. Previously, support will become resistance, and previous resistance will become support. Important point, when prices reach round numbers, the tendency to buy and sell increases. How are important reversal points determined? There are many options. Demark or Williams method. In Demark's or Williams method, determining a reversal point by using the number of bars in a bar chart on either side of the suspected reversal point. For example, if we consider this as a reversal point, there should be two troughs below this reversal point prior to this bar, and there are two bars with higher troughs next to the reversal point. And for example, if we see peaks, if there are, this is considered as a peak because in the previous two bars, they are lower highs, and in the following two bars, there are lower highs. Hence, we determine this as a P. This is D. Marks and Williams reversal points method. Percentage method. For example, anytime the price declines more than 1% makes a low, and the rallies more than 1% would define a 1% of trough. 1% is just an example. It can be 2%, 3%, whatever it is, depending upon stock or commodity, whatever it is. Gun 2-day swing method. Gun 2-day swing method is similar to DeMark or Williams method. However, in this, the reversal point, either it's a trough or a peak, determined based on the next following two bars. The previous bars are not considered. The following two bars are considered here. High volume method, very large volume can also identify a significant reversal point. In this picture, this is considered as a reversal point because there is a high volume, more than average observed here. How are support and resistance zones drawn? Let us see. So this is a chart. There are peaks and troughs. In point A and point B, the peaks are at the same price level, almost at the same price level. So we draw a resistance line. The resistance line extends to the future and as well goes to the past. Similarly, we'll draw support line. While drawing the support line, all the troughs are not at the same price. There are troughs a little bit higher and there are some troughs a little bit lower. Almost identical or near to each other. So if you see 1, 2, 3, 4, all are grouped together, not in a single point, but in a smaller range. So this zone or range, smaller range is called as support zone. If it happens at the resistance level, then we call it as resistance zone. If there are more troughs at a specific support point or a support zone, if there are more peaks at the same resistance line or resistance zone, the validity of the resistance in support is more. And you can observe another point here, X. This is the resistance zone. When prices break through, then this resistance will act as support. And similarly, for the support line, if it breaks down below, then this will act as a resistance line. Range trading. We have different kinds of trends. We already seen upward trend, downward trend, range, trading range. It's highly recommended not to trade within a range because it's highly risky and it's for professional traders. Always either trade on a trend, upward trend or downward trend. Breakout trading, Donchian breakout method or 4-week breakout system, which says buy when the highest high over the past 4 weeks is broken and sell when the lowest low over the past 4 weeks is broken. Breakout trading is nothing but prices break the resistance line and go above. It's highly recommended to trade breakout trading as per the literature. Similarly, in the support zone, if the support zone is broken and if the price travels down, that is considered as breakout trading. It's highly recommended to trade those trades as per the literature. Directional trends up and down, which is upward trend when a peak and trough occur at higher price level than the immediate previous peak and trough, which we already reviewed. Downward trend, peak and trough lower than the previous peak and trough, the trend had turned down. How is the uptrend spotted? There are multiple ways we can spot a trend, uptrend or downtrend. Here, the first option is using a regression line. Fitting two sets of data, price and time to a straight line. This method is called linear regression. Line derived from the formula is called regression line. Line has two variables, its starting point and its slope. the line is said to be the best fit to the data. This is the regression line. Based on price and time, this line is the center line is drawn, and this will travel through the price. Two things we need to consider is the trend of the line and the slope of the line. So these two lines drawn above and below this regression line, which is the standard deviation, and the regression is an important concept and chapter which will be covered in the future levels. I suppose in level 3. Using trend lines, all that is needed is two support reversal points or two resistance reversal points. A line is drawn between the reversal points. At least we need two support reversal points and two resistance reversal points, and a trend line is drawn in between, which is called trend line. There are multiple ways to draw the trend line. Here they are giving a technique to draw a trend line. Scale and trend lines. For shorter term, trend lines may be drawn on the arithmetic chart. For longer term, trend lines may be drawn on the logarithmic chart. In the previous chapter, we seen the difference between arithmetic and logarithmic charts. If you are not aware of it, please refer the previous video. Accelerating trend lines. Trend lines are drawn adjacent to the price troughs. If the prices move upward, trend lines bend and move upwards, which is accelerating trend line. This is theoretical. We should be aware as per the literature. Decelerating trend lines. The another name for decelerating trend line is fan line, drawn thrice to new resistance. We have a peak. From this peak, we draw the first trend line. When this trend line is broken, then we draw another second trend line connecting the peaks. When the second trend line is broken, the third trend line is drawn connecting the peaks. When the third line is broken, when the price move above this third line, then we consider it as trend change happened. We won't draw another line as fourth line. Again, theoretical concept, you should be aware as per the literature. General rules for trend lines. The longer and the more times that the drawn line is touched by prices, the more significant it is when the line is finally broken. The steeper the trend line, the sooner it will be broken. The trend line should never be considered exact, largely because price action within a bar may be influenced for a short time by exogenous factors. There may be intraday trading, and during intraday trading, there will be minor changes to the prices, because of which we cannot expect the trend line to be precise. Closing price represents longer term players, determination of supply and demand, and is thus a truer figure for drawing longer trend lines. Channels. Uptrend lines should be plotted between support and troughs. An uptrend line is drawn between support troughs. Downward trend line should be plotted between resistance peaks. In case of downward trend, it will be opposite. Channel. A line is plotted through resistance reversal points and is parallel to the underlying uptrend line and vice versa. For the uptrend, we'll connect the resistance reversal points, and this is called as channel. Final proof that the channel has ended is when the price breaks the trend line. Internal trend lines. Difficult to recognize and has only limited value. Line drawn through trending price action such that a large number of minor reversal touch the line both from above and below. This is the trend line. This is internal trend line. Main trend line, internal trend line. Other types of trend lines. Trend lines on point and figure charts. We'll be covering point and figure chart in the future chapter. But when we draw a 45-degree trend line touching the support points, then it is trend line on point and figure chart. Similarly, the resistance line as well, 45-degree lines. Speed lines. In this example, there is a trough. From this trough, we'll connect the next highest peak and it will create a box. From the thirds to half, we'll draw three lines from this lowest trough, three lines from this lowest trough. And this is called as speed lines. This is theoretical, but as per the literature, we should be aware of. Andrew Pitchfork. Andrew Pitchfork will identify the lowest trough. From this lower trough, we'll connect point number 2 and point number 3. And in between at the 50% level, from point number 1, we'll draw another line which is called as Andrew Pitchfork. Last but not the least, gun fan lines. Mr. W.D. Gunn, he created this trend line using geometric pattern. Thank you, friends. Thanks for your time. See you in the next video. Bye bye.